right, traders, let's get a quick audio and video check in for our charts and coffee for December 17. Happy Thursday, everybody. Hope everyone's doing well. All right, good to see everybody. Okay, so as always, if you have any questions, feel free to type them in, and here they come. We got some questions about, gold today. All right, some gold. Good morning, good morning. Good to see everybody. All right, so got some questions about gold, Nvidia. All right, let's do it. Okay, so first of all, if this is your first episode of Charts and Coffee, welcome. We talk about charts and we drink a lot of coffee. I actually put some cream in my coffee today, which I almost never do. It's also my third giant mug of coffee this morning. So those of you that are going to join me in the futures room in about 18 minutes, be warned. This is highly caffeinated, slightly salty Raghee. You will see it in the notes when I send them out today. And by the way, one of the things that we do, I don't want to call it a newsletter because that's not what it is, but throughout the day, this is the 2 Strong Coffee edition. So you guys are getting a sneak peek at the notes. And this is the kind of stuff that I send out where I do a little bit of a brain dump in terms of what I'm going to talk about, what I'm going to share, what I'm going to trade, what I've got my eye on. And, one of the things we continue to watch is Brexit, the pound. We've talked about, and I know we've talked about that in many episodes here of Charts and Coffees, short the dollar. And then that, also in some ways relates back to the Bitcoin narrative in terms of, what we have going on in terms of the really what it is. I've gotten a lot of questions on this, so I'll just put it out there. What is the Bitcoin trade right now, gang? Do not engage Bitcoin unless truly, and I mean this sincerely, unless you hate yourself, don't be buying Bitcoin at the highs, please. All right, number 2, like any good uptrend, like any healthy uptrend, I will anticipate a pullback. Within the pullback, if you want to get long, do that. But what is Bitcoin? It's a hedge against inflation, gang. I think who was it that sort of publicly said that? And I think it was maybe 2 years ago, and it was Paul Tudor Jones that I believe about 2 years ago, maybe less, talked about this being a hedge against inflation, which quite frankly, I think he's pretty spot on about it. So every narrative, every iteration of an uptrend tends to have a whole new psychological fuel. And I think right now that's the psychological fuel for Bitcoin. Now, kind of along those lines, but not directly, let's talk about gold. Gold is up today. So inevitably, people are going to have their attention on gold. I'm glad it's up. It's still establishing a range. We have a resistance level right around 1912, as you can see here on this chart. Actually, let me, there you go. Now you can see it better. So you can see right there on this chart. I'm going to wait for gold to settle down. I'm not in any rush to trade gold. One of the things that we touch on, and I do this from time to time when it's relevant, and that is, where are we within the macro stages? In the early 90s, one of my mentors, I was very lucky to have 3 very impactful mentors in my life. And one of them taught me how macroeconomics works and kind of a 4-pillar or 4-stage way of looking at macroeconomics. He was on the global investment desk of a major brokerage, and this is the way they looked at macroeconomics. And it's the 4 pillars, by the way, are inflation, GDP, money supply, and monetary policy. And then everything falls under one of those 4 categories. Well, macroeconomically, I'm really not in love with gold in the current stage that we're in. I'm not saying that I want to short gold. I'd rather be long, but I'm in no rush to chase gold up at 1876, maybe at 1776, right? At the bottom end of the range, I can start looking at gold again. But both technically and macroeconomically, I am in no rush. Now, if you want to play gold today, shorten the time frame up and day trade it, right? Shorten the time frame up. There's no harm in looking at a market from a different perspective. And sometimes the best perspective isn't long or short, it's short-term or long-term, right? And so that's what I would recommend for gold. All right, moving on to Nvidia. Nvidia is a market moving sideways of all the things that I could be in right now, if I'm looking at Nvidia with a fresh set of eyes, then I'd pass. I don't want to short Nvidia. I would simply pass. The problem with Nvidia right now isn't that I'm not bullish. I am. This is a market that's gone into consolidation after an uptrend. So the transition isn't a broken uptrend, it's a downtrend, gang. That's just erroneous thinking. What you want to remember is a transitioned uptrend is either going to initially be chop, and then it can continue to chop, or will initially be chop, and then it can transition into consolidation, which is exactly what Nvidia has done. So we're just waiting now for when we'll get some sort of high volume confirmation momentum breakout, probably through 550.5. So it's a bit of a waiting game now. Am I bullish? Absolutely. But the problem is just when are we going to get that move is the issue. So if I'm looking at Nvidia with a fresh set of eyes, I'll pass. If I'm in it, as long as I'm not running out of time on the options that I've got, I'm assuming it's options, because if you're in the underlying Nvidia, just sit, right? You're not in any kind of time theta crunch. So if you're in the option, look at how much time you have to expiration and make a judgment call as far as whether or not time decay is finally eroding the value of your premium. Other than that, sit. I'm bullish. All right, next up is how long does the Santa rally last? Nick, it's a good question. We can look at seasonal trends and get some sort of generalization. I haven't cracked open the Stock Traders Almanac in a couple of episodes here. So taking a look at Thursday, what does Thursday say? Nothing. Let's see. Triple witching for Friday has been up at the last 25 of 37 days. Let's see what else we have here. After triple witching, we've been up 21 out of the last 28, not days, years. And then so a lot of people feel the Santa rally begins 23rd, 24th, which would be next Wednesday, Thursday. The last trading day before Christmas has been up 8 out of the last 12 years. So what I would say you probably want to do here is look at the structure of the market, which is up. I've received a lot of questions the last few, probably since last week, late last week, about people asking about whether or not the market's going to have some big rollover. Gang, the more you hear in financial media, this, by the way, is when financial media, namely television, AKA the dumb box, as my mother called it, still does. Boy, does she love her Hallmark channel, though. I guess it's not the dumb box then. Anyway, the thing to remember about trends is that, number one, the idea is not to short the top of a trend and call yourself a contrarian or say you're hedging. I don't believe in contrarian trades, and I don't believe in hedging. I'm a trader, right? So what we want to do is have directional bias, which is A, bullish, and have a plan, which is B, buy the pullback. If we tend to get a pullback, this is what I wanted to mention about financial media. If a lot of folks are talking about a rollover, if a lot of folks are saying we're due for a big correction, newsflash, it ain't gonna happen. When do these big drops come? When nobody's talking about it, or even worse, they've got these projections into the stratosphere. They don't come when we're all talking about it. Why is that? It's because it's already been discounted. There's actually a really good common sense reason for that. So with that in mind, I wouldn't even call this a Santa rally. This is a reflation trade fueled by cheap money, vaccine hopes, a $900 million stimulus package, which has been discounted into the market more times than I can recall, which was actually discounted as a over $1.5 to $2 trillion package. So 900 million is really a disappointment. But what did we hear from the Federal Reserve yesterday? They didn't really have any negative commentary about their ongoing bond buying program. Why does that matter? We talked about that in yesterday's episode. As long as they're buying longer term yields, that keeps the stock market and corporate yields looking very attractive. So they're not deviating from that plan. I don't think there was anything in what Fed Powell said that would make us think that they're deviating from that plan. So onward and upward, gang. Onward and upward. So I wouldn't even call this the Santa rally unless Santa is Jerome Powell, in which case, yeah, don't buy at the highs though. We will get pullback. So then I've got to ask you guys, really tough question for some traders who are used to buying new highs. If you like 3,700, if anybody here in the room likes 3,700, I guess the question is, why not like 3,600? Why not like the days that were down, right? So please don't fall into the pack of what Wall Street does, which is they like buying markets that are higher, okay? If you have a healthy trend and you can take advantage of a retracement, that's really what you want to do. So Eric says, I made a peppermint mocha. I love it. I love it. So again, what's the idea here? Let's not label this a Santa rally. Let's just call this what it is, which is an uptrend that I'd be willing to buy pullbacks in. So thank you for the question, Nick. Good stuff. And yeah, salty Raghee. Yeah, salty Raghee. I think the caffeine's wearing off, but the notes are pretty darn salty this morning. All right. Does short dollar mean long gold? So no, and I'll tell you right now why. Give me one moment here. So if I'm looking at the dollar, sorry for looking away, I'm actually looking at another chart. So if I'm looking at the dollar and gold, right now the correlation between the dollar and gold is actually pretty low. And I think that there's this desire for market participants to sort of compartmentalize the market by saying, well, if this is up, this is down. And if this is down, this must be moving higher, et cetera. And frankly, very little in the market works that way over time. The only markets that have a very steady, the only two markets, and I mean the only two markets that have a very steady negative or inverse correlation, in other words, when one zigs, the other zags, is the euro and the US dollar. No other market has as tight a correlation as those two have in terms of the euro-US pair or the 6E futures or the FXE euro ETF. And it's steady. It's a very high correlation. Remember, correlations come and go. Sometimes the dollar and gold will have a negative correlation, and other times they don't really track off one another at all. And right now we're in a stage where just be very careful when people want to tie markets into these sort of correlative effects. Nassim Taleb said it perfectly when he said that correlation is charlatanism, and it's true. It's true because when you look at the typical flux and the low percentages that certain markets have, even though we think anecdotally they're linked, they're really, really not. Sometimes what you're really looking for is causation. And if you're wondering, why do the euro and US dollar move so wonderfully inversely correlated to one another? It's causation. It's causation. So thank you for the question. So no, it does not always mean that. The dollar is short right now because the dollar is short right now. Other currencies are gaining against it. Australian dollar, New Zealand dollar. I would keep an eye on the Canadian dollar, the euro for sure. Mike says, crude's looking good today. Yeah, let me show you how long crude's been looking good for. And I concur. Absolutely, Mike. So take a look at our indicator at the bottom of this chart. My head's sort of in the way here. Hang on, let me move this for a sec. What that tells you is that the structure of that market based on those exponential moving averages, 8, 13, 21, and 34, are indicating that this market has resumed the uptrend. So gold's been looking good. I'm absolutely fine with pullback buys on the daily. Now, interestingly enough, and I talked about this in the free video, and if you're watching this on YouTube, you can check out the free video over at Simpler Trading's YouTube channel. And one of the things that we did yesterday, and this is something I look for every week, and that's known as the first come, first serve fade. And here's how it works. We wait for the 1030 crude oil inventories to come out. We look to see which end of the hourly price movement range we go to first. We've got to get up into that range. You can see we did so right in here. And then we short it. We short it and just look for the move back lower. And that's shorting or fading the top of the hourly price movement range, the top of the volatility bungee cord, if you will. And that's a process that I developed based on the data that my good friends over at AutoChartist developed. I think they developed that tool 10 or 12 years ago. And then I started doing this process in Forex probably 7 or 8 years ago. And as they expanded more markets, now they have stocks, ETFs, crypto, futures. And as I have this data now, this historical price movement range data, there's a lot we can do with that. So that's one of the things that I liked with Crude. So I don't mind short-term trading it in the meanwhile, Mike. So yeah, Crude is looking good, not only as a trading name, but if I can get a pullback buy, absolutely. Yeah, I'm with you there. Okay. So let's see. What do I think of the beautiful weekly squeezes? I don't play weekly time frames. Yeah, I don't play weekly time frames at all. And here's why. If my risk tolerance is geared towards the amount of price movement a market can move in a week, then I can play a weekly. I think weeklies and monthlies are interesting, not for traders, but rather for longer term time horizon traders and really more of a portfolio or an investing type of approach. So for me, a weekly time frame is not really applicable to what most people's risk tolerances are. So structurally, I'm sure it's fine, but in terms of the reality of assuming the risk on a weekly, I think a lot of folks are very unprepared for the kind of risk a longer term time frame would bring. So with that being said, what I'll do, if I have a setup that is alerting me to potential action in a name, like a squeeze, I'll go look at what the daily structure is. And CMG is something we've been watching for a little while in terms of the bounce. Then Netflix. Yeah, see, these are all sideways markets. Yeah, these are all sideways markets. And I'm just very uninterested in sideways markets. So I'm not a big fan of weekly timeframes. It's not a matter of not being a fan of the strategy. I'm not a fan of the time frame. And again, let me explain one more time why, because this is really important. Let's just take, for example, Netflix. And this has more to do with risk, gang. It has more to do with risk, which is something I think a lot of traders are unprepared for when they get into a weekly time frame trade. Look at the daily price movement range on Netflix. This is just one session. Notice how Netflix can average anywhere from about 18, 19 points to 24. Now imagine what Netflix can do over the course of a week, because that's what that weekly time frame is indicating. Is it easy to say a typical weekly time frame in terms of high to low can be well over 50 to maybe 75 points? So think about your reward, which is also going to be nice because large because of the weekly price movement ranges, but think of the risk. And that's where a lot of traders get burnt by longer term timeframes. And that's why I say it's more about the time frame and less about the actual strategy or the trigger. Same thing for trend following weekly charts. Same thing. Okay. All right. So I've got time for about one more question. And again, thank you for all the questions. So as far as JNK and HYG, yeah, absolutely. Remember, JNK, HYG, we're buying stocks, gang. The government's buying stocks. The Federal Reserve's buying stocks. They can call it whatever they'd like. They can wrap it up into whatever they'd like. But this is something that happened earlier this year. And they're empowered to buy stocks. They went about buying high yield corporate and junk because that's what helps the American public. I can't even say that with a straight face. That's what helps Wall Street. So with that being said, yeah, it's hard to bet against what's happening with the reflation trade. It's hard to bet what's happening with longer term yields. It just drives the market, market participants into equities and into, in this case, corporate debt. So yeah, I think this has been in play on and off throughout the year. John, to your question, yeah, absolutely. Absolutely. Okay. All right, gang. And just like that, our 20 minutes just flies on by. So I've got to go get to work. We're going to go day trade in the futures room. Those of you that are joining me right now who are in the futures room, I'll see you in just a moment. Everyone else, thank you as always for your time. Check out the free site countdowntrader.com, countdowntrader.com for a free newsletter. If you like some of the approaches I'm talking about, some of the tactics and tools, I talk about them in that free newsletter. Really good information. So check that out. In the meanwhile, have a great day. And we got Powell in our rearview mirror. We got Santa up ahead. Let's look for the long side of the market, gang. Let's not get presumptuously short. Let's not start picking tops and all sorts of other self-destructive behaviors. All right, gang, be good to each other. I will talk with you soon.